You are selling gold at a resistance zone, and your initial scenario seems logical. But just one price movement up can trigger a stop loss, resulting in a negative balance. And then the price reverses sharply. Exactly as you predicted. This feeling isn't due to a volatile market, but rather because you have taken the wrong position in a liquidity game. If you are trading gold and especially want to optimize your Exness Gold strategy, understanding this mechanism is essential, not an option. This video will help you stay on the winning side in those stop-loss situations. This is the Exness Market Channel, where we provide the most useful information about trading activities on the Exness platform. We are a leading development partner of Exness. If you're new to Exness Market, make sure to hit the subscribe button to stay updated with our latest videos. If you have any questions, feel free to leave a comment below, and our team will get back to you as soon as possible. You'll find the registration guide and the latest Exness updates in the video description and pinned comment. Besides this channel, you can also visit our Exness Market website to explore more about Exness. I will guide you through the process of placing orders in practice. First, you need to analyze the trend. Then, we need to identify the liquidity zone. I will switch to the H1 or H4 chart. First, we need to identify the liquidity zone. Let us assume this is the liquidity zone we see. After identifying this liquidity zone, our task is to patiently wait for the price to approach that zone, and there must be a strong breakout. Let us say this is a backtest order. Once you have identified the liquidity zone that the price has touched, you need to patiently wait for the price to break through it. Then, you move on to smaller timeframes like M1 or M5 to find entry points. Specifically, you will look for candlestick patterns with long wicks, such as pin bars or engulfing patterns. After identifying that zone, you will switch back to a smaller time frame. For example, if you have identified the zone and switched to M1, you might see a candlestick with a long wick. Similarly, you can switch to M5 for a more certain entry. Here is an example. After identifying the liquidity zone, you switch to M5 and see a very clear order confirmation signal, a candlestick with a very long wick. So, right after the candle is complete, you can enter the trade immediately. For example, once we have identified the candle and it is complete, we will enter a buy order right here, and the stop loss will be placed approximately below the base of this candle. The take profit can be set according to the risk-reward ratio. For example, if the stop loss is around 5 points and your risk reward is 1 to 2, you will have to set the take profit at around 10 points or more. So why is the Exness Gold strategy linked to the Exness Zero Account? Because gold is a product with very rapid fluctuations during candlestick wicks. The spread and slippage directly determine whether you can get a good price and whether your short stop loss will survive. With a regular account, the spread for gold can be from 20 to 30. You can see this here. Specifically, the spread is currently around 10 to 20. The Exness Zero Account is different. The spread is almost zero for most of the trading time. Now, let us switch to the Zero Account. There is no gold option here yet. I will find the gold option. As you can see, the spread is almost zero. The buy and sell prices are almost the same. This is a huge advantage for scalping. It allows you to see the price at which the trade is executed, preventing losses immediately upon entry and enabling accurate risk and reward calculations. Let us say you see 50 as the entry price. I will enter a trade at 4,503. As you can see, the entry price is the price I see. This is a significant advantage of the Exness Zero Account. They both share the same habit. Sell at the resistance zone and place the stop loss right above the previous peak, and buy at the support zone and place the stop loss right below the previous bottom. These positions will create a cluster of extremely high liquidity, which is the target of large capital flows. For example, in this case, many people will enter a sell order right at this point. Suppose you sell right at this point and then place your stop loss a few prices away. And you can see the result. If we had followed that scenario, we would have lost money. And in Exness Gold strategy, you also need to understand that a recurring pattern in gold is the fakeout breakout, where the price breaks through the previous peak, triggering a buy breakout order and simultaneously wiping out the stop loss of the sell side. And immediately after that, when the liquidity is sufficient, the price pulls back strongly and reverses. Stop loss in gold is a game of speed, accuracy, and the right tools. You cannot use high spreads to judge liquidity sweeps in seconds. If you are serious about gold and long-term profits, combining the Exness Gold Strategy with an Exness Zero Account is not an option, but a necessity. The registration link is in the pinned comment and description of this video. Try applying this strategy on a demo account or with small volumes on a live account and comment on your trading results so we can analyze them further. If you found this video helpful, do not forget to like and subscribe to the X Markets channel to avoid missing more in-depth investment analysis videos.